Good morning, everybody. Welcome to the latest in our Aspida webinar series. This is the second in particular. Last week, we looked at Guernsey as a jurisdiction and its resilience. If you missed that, you can take another look on our website, aspidagroup.com. This week, I'm delighted to say that we are joined by another two guests looking at building business resilience itself. If you have questions as we go through, there will be an opportunity at the end for us to respond to those for you. Please do use the question facility on your screens to post those. I'm delighted to say that our second webinar is in partnership with Carey Olsen, and in particular to welcome Ben Morgan as one of our guest presenters today. Ben has a distinguished corporate and finance career with Carey Olsen in Guernsey, and will be sharing some of his experiences. Amongst his many claims to fame is recognition in the Legal 500 Hall of Fame, particularly for his investment funds experience and as a result of some excellent client feedback. But first up is my colleague, Simon Walker. Simon is head of Aspida's business advisory, as a chartered accountant with over 20 years finance sector experience, and brings with him a very broad experience of operating both in executive and non-executive roles in regulated environments. Simon will kick us off, followed by Ben, and an opportunity to come back to your questions afterwards. Simon, over to you.
Thank you, Wayne. Morning, everybody. I thought I would start off by talking a little bit about business resilience in general. Then I would like to have a think about the global view, what business resilience actually means, what the current challenges have meant in terms of business resilience, what lessons can have been learnt, and what we as business leaders should really be thinking about going forwards to enable our businesses to become ever more resilient. So a good place to start, as ever, is with the definition. The definition I have here is that business resilience is the ability to quickly adapt to disruption and maintain a continuous service. However, what is different about the current circumstances is that this challenge is not uniform due to steps to control the virus spread. And those steps have differed by country. So, for example, if we look at lockdown rules in countries such as Denmark and Sweden and compare them to the approaches taken, for example, in the UK, or within the US, look at the different steps being taken by individual states, and what does that mean for individual businesses, which may be of the same nature, but may happen to be in different states in the US. That presents different challenges. There are some industries as well where, however resilient the planning may have been, and however much foresight boards may have had, it's simply outside of their control to a large extent, the kind of impact which we're seeing. Industries which spring to mind are the hospitality sector, travel sector, and certainly the aviation industry. So, to a degree, however much planning you may or may not have done, there are elements here with the current situation where, frankly, you couldn't have possibly planned for this. So there's a couple of examples of reports of surveys that I've been thinking about. So when we're thinking about resilience, we need to consider any situation which we believe may impact on our business operations. Now, clearly, a lot of businesses have struggled, and for many, there is little they could have done to prepare, as I've just mentioned. So it's worth considering whether the current situation was expected, and therefore whether businesses should have made preparations. So the first report I looked at was Aon's 2019 Global Risk Management Survey. Now, this is a survey of risk managers across a host of industries, which is carried out every 2 years. So in 2019, we can see here that pandemic risk was rated down as low as number 60. Now, although the first couple of risks in their economic slowdown and damage to reputation and brand are clearly what we're seeing, it wasn't a situation that pandemics were seen as a high probability risk. And this is risk managers globally across a whole range of industries. However, I think it's probably fair to say that when we look at this report next year, when the 2021 report is done, that pandemic risk, infectious diseases will be a lot higher. I would expect that to be up in the top 5 again. So the other report I looked at was the World Economic Forum Global Risk Report, which came out at the start of this year. And what you can pick out here is infectious diseases were, again, not in the top 10 in terms of likelihood, but they were at number 10 in terms of impact. So there we could see that whilst I think the survey respondents in this case also didn't perceive this to be a high likelihood, they did understand that should this happen, it would have a significant impact. But then I also looked at the World Economic Forum global risk reports for the last, however many years, 20 years or so. And what I noticed was that pandemics and infectious diseases had actually been a lot higher in years gone past, and in fact reached number 2. I think it was in 2015. So what does that mean? Why has that changed, and what are globally the big risks that companies should be considering? And according to the World Economic Forum, if you look at how that's moved over the last 5 years or so, it's really moved to a focus on climate change. Now, this is arguable, but therefore we could argue that there's been a drop in focus, certainly from governments, and you could say in the UK and the US in particular, where, in the UK, certainly a failure to act on recommendations that have been made. And then the US, depending on who you read, whether you're reading Democrat or Republican news, and this is always the big challenge in the current environment, there's certainly been a reduction in the pandemic response unit in 2018, and that was the unit set up under the Obama administration. If I was to look at a Democrat news site, it would tell me that unit was effectively completely disbanded. If I look at Republicans, they'll say it was streamlined. But whatever the truth is, there was a reduction in focus on this, really because it had fallen away from the public consciousness, and climate change had really moved on there. The forum's risk report also point to pressures which obviously have now come to the fore, where health systems are under great pressure, and that's really because of the improvements in treatments against non-communicable conditions and increased human longevity, along with hesitancy to adhere to vaccine programs and increased drug resistance. So really, all of those point to a reduction in our readiness to build resilience for the current situation. So if we go back to the question of whether this was expected or whether businesses should have been working on becoming more resilient in anticipation of COVID-19, I guess the next question you need to ask yourself is what color is this, to use the term, swan? So, just as a reminder, a black swan event is something which you would perceive to have an extraordinary impact on an economy, but which is so very far removed, so unlikely that you kind of think it will never happen. I guess the example I typically use is the risk of aliens invading Earth, right? I tend to think this is more of the other two. I found out there's 2 other colors of swans as well when we've got to be thinking about this subject. One is a grey swan event. So this is really where, whilst you wouldn't be expecting it, there was a recognition that it could happen. I've also heard the term green swans, and that is, I guess I don't adhere to this one. This is not the one I would choose, but a green swan event appears to be where an event like this causes fundamental change in the way that we behave, and is kind of like a phoenix from the ashes in terms of environmental change, hence the term of green swan. My view, given some of the points on here, and certainly having watched Bill Gates' TED talk in 2015, is that this is a grey swan event. I think, there were precursors to this, and from a personal point of view, I don't think this is the last such event we're going to see. And given that point, potentially the way that I see this is this really, I think, will come to be seen as a practice run for something which is much worse in due course, and I will come back to that. So the key thing here is that lessons are learned and investments are made to prepare us for the next version. So in summary, in relation to the question of whether this was expected or not, given the reports I just referred to earlier and the points above, the pandemic was not widely anticipated, but now it is here. We, as business leaders, need to demonstrate an ability to view the world through this lens and adapt accordingly. And it's the ability to adapt accordingly which will enable us to build the resilience which we're going to need in the future should this recur. So, what should we do? So with what we know now, what should businesses be doing to become more resilient? As I've just mentioned, the current situation gives us a new lens through which we need to view the world. And so when I've been looking at this and thinking it through, I've reflected on questions which are typically asked of boards, whether that's in an annual corporate governance review or whether it's in relation to a regulatory return that we need to make. What are those questions that we're typically asked? And my view is that the questions need to fundamentally change. So a typical question that boards might sit around a table and ask themselves once a year is, do we have a business continuity plan? Do we have a disaster recovery suite? Those aren't the right questions anymore. And it's certainly not, I wouldn't advise companies that a BCP plan is something you look at once a year, you agree to, and then you file it away in a cabinet somewhere. And that is, again, a point I'll come back to at the end. The question, I think, in relation to this, given that disaster recovery suites are no longer an office that you're renting down the road with a suite of computers in readiness for a fire in your office, the disaster recovery suite is actually, as we've just learned now, our colleagues' homes. That's where our disaster recovery suites have become. So, if you're in the business of providing disaster recovery suites, I suspect you've got an altogether different type of challenge. So the question here is, are we able to switch to an operating model where all colleagues can operate remotely? And there's a lesson we've learned here, and that's the question we should be asking ourselves. Another question in relation to our financial resources and our liquidity. Has the board reviewed the latest financial resources requirement? Again, I'm not certain that's the right question. I think the question is the board comfortable that the FRR surplus is sufficient, and how is that trending? So, why do I think that's the question? Because we're all going to be facing liquidity challenges and liquidity management. Because, as I said before, there are certain sectors of the economy which are undoubtedly going to suffer. For a lot of us, those are clients. We need to be making sure that we understand those challenges and we're taking that next step down. So we're not simply looking at an FRR calculation and ticking a box which says, yes, it's above 25%. What we're doing is we're trying to understand how that's trending over time. What are the business challenges there? And how can we advise clients if we're seeing these kind of trends? Another question which we're asking, certainly forms part of the FRR calculation, is do we have professional indemnity insurance? Certainly in the financial services sector. Again, wrong question in the current circumstances. Still a valid question, but probably an additional question in this case. Do we have business interruption insurance, and are we covered? And that second point is a point I'm going to come back to, because that is a certain bone of contention at the current time. Do we have appropriate people in our prescribed positions? Wrong question. The question really is, for example, is your money laundering compliance officer able to carry out his or her role effectively whilst potentially unable to visit client offices? Yes or no? Well, it's a challenge, and there are solutions to that, and we'll come back to that at the end. Another question, do we have appropriate level of information security within the business? Again, I would extend that question. And the question really is whether that's regardless of whether colleagues are working from within an office environment or from their homes. Both have different levels of security built in. For example, can your colleagues at home print off documents? What does that mean? Do they shred documents? How do you know that's being shredded? How do you know what's being printed? How do you know the level of security? Is there Wi-Fi access security enabled, etc., etc.? There's lots of questions which I think we should be asking ourselves. So if I think back to the Aon survey, the Aon survey had number one risk as economic shutdown, economic slowdown, and the number two risk was damage to reputation and brand. And here's a very well-known catchphrase from Warren Buffett, which is all about the time it takes to build up a reputation, being extremely long, but just how quickly you can lose that reputation and that brand equity. And the current period, there are, as I will explain, there are people who are dealing well on this front and people who are perhaps not doing so well. So, a question. There is another question. So some of the questions have changed, but there are other fundamental questions which I think are really important at the current time. So here's the first one. How do we protect or enhance our brand value in the current circumstances? And as I've said, in all of this, whether you're looking at it on a country level or an industry level or a business level, there's winners and there's losers. So if I think about a couple of examples of companies which I think are enhancing their reputations and therefore becoming more resilient, Co-op is a good example, which really has stressed its community roots, use of local faces, and that chimes with local supply chains, and the push for ensuring that that communities become more self-sufficient. So I think that chimes really well with the public mood. If you look at Admiral, so Admiral Insurance on the car insurance side, obviously people are staying at home; they're not using their cars as much. And so far, they've refunded £110 million of premium as a stay-at-home refund, which again, they've taken that step off their own back. Very positive, very positive for their reputation, for their brand. There's others who I would argue are not doing quite so well. So here's the first one I would say is Virgin. So Virgin with Richard Branson, I would ask, it's just a question, and it's open for debate, but in the shape of Richard Branson, the question I would ask myself about Virgin is, has the group's greatest asset become its greatest liability? And the reason I say that is, when you got Virgin Atlantic looking for government support, and then you look against the public mood and some of the actions of the past. So if you think about, pictures of Richard Branson standing on a beach on Necker Island, the fact that he sued the NHS, which is kind of like a cardinal sin at the moment, given the public's attitude to the NHS, I would argue that there is literally no chance of that bailout happening anytime soon. Hiscox, I find a really interesting example, and I think it's probably the best potential example, just thinking back to the quote I just mentioned from Warren Buffett. So Hiscox is insurance entity which was formed in 1901, so it's 119 years old. Now, one of the real cornerstones of Hiscox is integrity, and actually one of their watch phrases is "do the right thing, however hard," right? Which is really interesting. You'll find it in a lot of their materials. You'll find it in a lot of their advertising. Yet Hiscox was the company which came out right at the start of this and talked about business interruption claims, business interruption wordings, because there was a lot of difference of opinion as to whether the current events are covered under a typically opaque business interruption wording, as we always see in insurance policy wordings. What they've clearly done is they've now backpedaled on that and are saying, actually, it's not covered. Now, what that says to me is, here's a company which said you would be covered, has probably gone away and done the sums, and has had to presumably strike a balance between the reputational damage that this will inflict on the brand versus the amount of money they would have to pay out in claims if they're validated. And maybe that's the right decision, maybe it's the wrong decision. But my personal view is that's a bad decision. And the reason it's a bad decision is starting to come through. So yesterday, it was announced the FCA are taking action against 8 insurers specifically over ambiguous wordings in their BI contracts. and Hiscox is involved in that, and that will come to court in the second half of July. There are billions of pounds in terms of claims value resting on that, and there are thousands of jobs resting on the outcome of those cases. So that will be an interesting one to watch. But I thought it was an interesting example of a business which is potentially reduced the value of its reputation in a very short period of time. So there's some other fundamental questions which need to be asked. What are our top risks? These will have changed. So if you think of some obvious ones, operational risks have changed, whether that's in relation to security, whether that's in relation to an ability to work remotely, or the digitalization of the business. Operational risks have fundamentally changed. Liquidity risk, as I said before, with a lot of businesses struggling at the current time, liquidity risk must be much higher as customers and clients are struggling to pay their bills. So that's a risk which has really changed in terms of the score you put next to it. And I would also say fraud risk is much higher, given financial difficulties that people are finding themselves in. So another question, how does the crisis impact our operating model? As I've just said, there is going to be an imperative to reconfigure operations, but it's also an opportunity. It's an opportunity for operational improvement. So there will be companies who have a lot of paper-based processes still. That's not going to work in this kind of situation if it recurs. So really, it's kind of a bit of a jolt for a lot of businesses to just really put the boosters on any push towards digitalization. There's also an opportunity here. So as we've all been finding out, I'm sure, meetings, having virtual meetings, having meetings by Zoom or Microsoft Teams has told us actually, one of the things that I've found is, there is an opportunity for much better cost control here. So for example, for us here in Guernsey, if we were going to have a meeting with a client in Gibraltar or Liechtenstein, for example, that would typically involve a couple of nights away because of the difficulty of our air links and timings of flights. Whereas actually, if it's just for a 3-hour meeting, for example, it's done. So I would expect operational efficiency improvements to come through, both in terms of pure operational efficiency, but also in terms of P&L costs, because you're not paying for hotels, et cetera, et cetera. So then just moving forward, one of the other fundamental questions which clearly needs to be asked is what's the regulator's view? And the view of the regulator here, there's 3 points. They're probably really mostly concerned about our ability to provide continuous service, and that's down to digitalization. Our financial health, and that's all about liquidity management, and ability to fulfill our regulatory obligations, such as compliance testing. Do we have access to offices? Can we go and do that test? And again, there are solutions there, which we are actively working on within our business in the form of new governance, risk and compliance platform capability, where actually all of those services could be provided remotely. And it would, that's the ideal solution in this situation for that question. So just had from my end, a couple of closing comments. As I said all the way through this, it's extremely unlikely that a pandemic of a similar or more dangerous nature will not recur. So we need to take this opportunity to understand what's happening, ask ourselves some different questions to make sure that we are more resilient and optimally positioned for the next time this happens. Remember, this could have been a lot worse. If we were talking about a virus where it was extremely deadly to people under the age of 40, for example, what would that mean? That would be completely different. So think about risks such as key person dependency. However macabre that sounds, that is something we need to be thinking about and planning for. So from our point of view, there's 3 immediate changes which I believe are required in most businesses. Firstly, you should be reviewing your risk register and mitigation plans to make sure that they are appropriate, given the new lens we're looking through. Contingency planning needs to sit at the very center of the business. It's a board level issue. This is going to require fundamental change in the way that we're looking at the world. It shouldn't be a box ticking exercise once a year where you file this in the cabinet and almost dust it off when you need it. And I think it's also really an incentive for us to push on with moving to a more digital model in terms of our operating model. And that's it, really. Those are my three closing comments from my point of view. So I'll just turn back to Wayne.
Simon, thank you very much. Please remember the opportunity to ask questions, which we will come back to after we invite Ben to add his perspective. So pleased to welcome back Ben Morgan from Carey Olsen. Ben, over to you.
Thank you very much, Wayne, and good morning, everyone, and hopefully you can hear me. I think we should start by having what amounts to a big shout out for Guernsey and what it's managed to do through this crisis, which has been if you can call it that, a remarkable response to the crisis. Remarkable because it's been a response which compares favourably with any other jurisdiction around the world. So well done, Guernsey, a big slap on the back. So Simon's done a very good job, an excellent job at covering off what risks have been picked up from lessons learned from the downturn that's ultimately come from operating in these challenging times. I'm going to, because there are parallels with most of our businesses, I'm going to quite quickly talk about what has been the experience of law firms generally in periods like this, and how they emerge from that. I'm then going to take you through my view of the market, generally the services that we've been asked to provide, and some of that's going to be very relevant to your businesses. And I'm going to finish off by reflecting on what has been going on in the world, because perhaps unsurprisingly, Guernsey has an extraordinarily good perspective of what is going on economically, because it through the different asset classes which the investment structures established in Guernsey invest in, has a pretty good view of what life is like out there. Just making a start then on the law firm position, and hopefully, as I say, there are very direct parallels with some of your businesses. I mean, the terrible thing first to acknowledge is that law firms do tend to weather economic downturns better than the wider economy, and you can all have a good laugh. Insolvency and restructuring practices usually flourish, as you can imagine. But they do have real challenges, and if those challenges aren't properly addressed, they fare pretty badly. And there were some very notable bankruptcies, law firm bankruptcies, that emerged from the last big event being the credit crunch. So what have law firms been doing or need to be doing in crises like this? Well, we've seen cash management is obviously key, and we've seen several UK law firms and firms around the world switch staff to 4 days, impose salary reductions. They've laid off staff, and also managed partner distribution expectations. Now, looking back at the last crises, it's worth perhaps mentioning that very, very few law firms emerged from the credit crunch in the same, or market position with the same market share as they did when they entered it. And as I said, there were some notable bankruptcies along the way too. Now, I mentioned the short-term resilience issues in the form of cash management. The hopefully more positive steps firms need to make in times like this is to work out which sectors, clients, practice areas, and geographies it needs to prioritize. What are the most important, likely the most important businesses for your firm, either looking forward several years or in the immediate or medium term. And crises like this often act as a circuit breaker, in effect accelerating changes in any given market, which for the more entrepreneurial of business men and women and lawyers out there is a real feast of opportunities. And in a law firm context, that usually involves lateral hires, acquiring other, I suppose, boutique offices, an entire team lift outs from other firms, and that's the sort of activity which will, I am sure, be now building. The other thing, and of course something that's presented a real challenge, is employee communication. So a law firm, as with hopefully most businesses, or at least those businesses with which you're all concerned, is all about the people. So restructuring and redeploying your human capital, and of course with COVID and the dispersion of that resource to people's homes, maintaining connectivity throughout the lockdown has been so important. Every member of your team has to know how meaningful their work is through this period, and their contribution also, of course, to how the firm emerges intact, or better still, hopefully stronger. Repricing your services, it's no different for a law firm. Reshaping your product offering and repricing it, which doesn't, by the way, necessarily mean reducing headline rates, but does mean looking at strategic investments in the application of one-off discounts on specific client transactions. If done properly, these can be extraordinary strategic moves and a fantastically effective way of positioning a business for recovery. Client communication and demand shift. If ever there was a time to be listening, if you can, to clients from their various homes, and Simon mentioned all the different means by which people have attempted to stay in touch, at least virtually. Well, communication is key, isn't it? And that doesn't just mean sending out notes of your expertise in the context of the challenges arising out of this pandemic. A simple 2-line personalized email to your referrer or to your client, or having that virtual catch up on Zoom is hugely important. So that I hope I haven't lost too many of you, is the sort of things that law firms are looking at doing in order to hopefully emerge in the league tables ahead of where they entered the relevant law firm league tables pre-COVID. The more global view of life, then, starting off with the position, or the question, I suppose, was the law and regulations ready for this pandemic? Well, No, it wasn't. Simon mentioned that very few businesses were ready for this. Well, the law and the regulation in most cases immediately presented challenges on which we've been busy advising. So things like physical attendance at shareholder and board meetings and the regulatory issues that chucks out, tax issues that chucks out, governance issues that chucks out, and not least of all, of course, in the context of the recent substance regulations. Things like practical stuff, like when you disperse, as we did, 500 employees to their different homes, things like electronic signatures, and whether they work was something, of course, at the top of everyone's list, with people finding it more difficult to do things like scan and send out original wet ink versions. Our view is that in almost all cases, a non-wet ink version works. And unfortunately, as with all downturns, we've been kept very busy advising on insolvency issues, with opinions required on directors' responsibilities, and of course whether the solvency test can be passed in the context of companies making distributions and dividends to its members. There have been an awful lot of, as you can imagine, conference calls trying to settle those sorts of issues. I mentioned at the start, Guernsey's a pretty good environment to extract data from in order to determine what's going on in the wider world, just because of the variety of alternative assets that are housed within structures here. Now, economists, of course, have been discussing the shape of the recession and whether the recovery is likely to be V-shaped, U-shaped, or W-shaped. One thing is for certain: the world will look and behave quite differently after this downturn, as Simon mentioned. Now, the pandemic has wreaked havoc for certain asset classes held in Guernsey structures, but for other asset classes, there's been very little sign of material distress arising out of COVID, particularly if you look at the data that's emerging from the listed investment fund sector, in which, as all of you hopefully know, Guernsey has a dominant market share. Albeit, albeit I know for some there are now signs of activist investors doing what they do best in downturns and keeping directors on their toes. So I accept that for certain asset classes in the slightest distress are now starting to hear from activists. For our other big, this is obviously my world, the other big part of our fund sector, the private equity world, it's very difficult to ascertain what the write-downs in terms of asset values will look like. In terms of transactional activity, buyouts fell 60% apparently between January and April. And the number of exits, so sales of assets, fell by 72%. So a pretty dramatic impact. But what I'm seeing on the ground is little rush on the part of general partners of limited partner private equity funds to sell assets, because right now the price is probably not right. But it's, of course, as the hopefully inevitable rebound takes shape, that aging pool of assets is likely to, I think, accelerate the exit activity. So what are general partners busy doing? They're busy stabilizing their existing portfolio. portfolios. But what the other thing they're doing is you can imagine, deals concluded in the build up to COVID are inevitably likely to do less well than those deals done either during this downturn or immediately after this downturn. So fund managers with dry powder, I think last time I looked, there was dry powder in the private equity fund world of something in the region of $2.5 trillion US. So $2.5 trillion of dry powder waiting to be deployed. Now, if now is a good time to be buying assets, and you can imagine that activity should be building, well, from our experience in Guernsey, that is certainly the case. There are right now a prolific number of NDAs being signed by Guernsey general partner boards. The boards are extraordinarily active looking at investments right now, which will hopefully kick out considerable activity. In terms of future fundraisings, well, for our IPO world, it's going to be quiet for some time. For the private equity market, it looking back for the year to date, remarkably strong, but I suspect that's a little bit misleading, because an awful lot of that money would actually have been raised probably pre-COVID. And last but not least, because I'm sure there may be questions that Wayne wants to ask, or others on the call would like to ask. The banks, what's happened this time around? Well, of course, they haven't gone into absolute paralysis as they did during the last crisis. So they haven't frozen in the same way that they did, but they're certainly taking stock and assessing their exposure, and I suppose making some pretty big decisions about what they do about the very deep macroeconomic uncertainty. And I guess for non-bank lenders, there will be perhaps less friendly activity building as they take steps to secure the assets they've lent against. And that, in a nutshell, Wayne and Simon and others on the call, is my observations from this current market distress. I must now, though, tell you that I am at my desk in the office. By no means a reflection of how Carey Olsen coped with COVID. It does, though, speak volumes for Guernsey's response. We did successfully send 500 people around the world in different jurisdictions back to their homes, and I'm delighted to say all of the things that Simon spoke about in terms of security and the ability to work remotely went I think even for us remarkably well.
Ben, thank you very much for a very insightful overview, both in terms of Carey Olsen's direct impact and what you are seeing and the view of the markets. I think one of the most noticeable things for this particular crisis, the pandemic, other than being the first one for many decades the banks have not been blamed for, is how it's impacted professional firms, not just lawyers. I know GPs was one particular profession that has been, I think, very strangely impacted. We do have a few questions. Whilst we just stop sharing the screen, Simon, one perhaps for you to kick off. Risk has often been a trade-off between impact and likelihood. We've all sat through those red, amber, green risk presentations.
They're good fun,
good fun for some, Simon. Yes, not necessarily all of us. But what advice might you give boards after the experience of COVID-19?
Okay, so when we talk about impact and likelihood, so impact and likelihood are two considerations which we would score against all risks identified by a board of directors as an integral part of the risk assessment process. Depending on the risk appetite of the business in question, that will determine the extent of any mitigating actions to be taken to bring the combined score, as it were, within the appetite which has previously been agreed by the board. So my advice to boards would be that really what they should be doing is holding a reconsideration of every element of their risk register, as there's now a more informed view of the impact and likelihood of both pandemics and all other risks which are impacted by this kind of event. So in a nutshell, what I would be doing is advising boards that we need to revisit your risk register and rescore.
Mm-hmm. Thank you. Yeah, and I'm sure many of us will, in the light of our immediate experiences, pay perhaps a bit more attention to them, I'm sure. Ben, one for you, if I may. You talked about accelerating out of the crisis and the pandemic, which I think is good advice both for our businesses and wider communities. How, though, do you balance the risk of overreacting at a time like this?
An excellent question. Not least of all in the context of one of the comments I made, which was how important your people are. The investment banks are notorious, aren't they, for laying off entire teams and shutting down entire business lines, and therefore I would say overreacting, particularly in markets where perhaps it's more challenging to then go out to the market and recover some of that expertise by re-employing people, and in so many cases actually having to restart entire practices. So there's an overreaction, isn't there, in that form, and law firms too will shut down what they regard as less profitable practices, and then regret it 2-3 years later when they realize how important that particular practice was to their overall offering. I mean, I dare say, I think most businesses will over accelerate on initiatives designed to see them good as they emerge from any rebound in whatever service or product offering they offer, and actually getting it right, Wayne, is really not a science. It's more I suspect an art, with perhaps a dash of luck chucked in, but it is so important to get that right, because, as I said, these sorts of disruptive events, particularly in my world, rarely see you emerge in the same market position as you entered the recession. That was definitely the case for law firms in the last credit crunch, and I dare say it was for other businesses.
Yeah, thank you, Ben. I think often holding your nerve is one of those very difficult things, I think, in any sort of leadership role, particularly at a time like this. There are in many different organizations and businesses where that has paid off, albeit clearly not overdoing it at the risk of taking no action at all. Always a very fine line. Last question, if I may, Simon, for you. You talked about the colour of swans, and Bill Gates now widely reported, but I'm not sure 4 years ago much was necessarily taken on board about what he was sharing as the risks that our world was threatened by. So how do we decide which warnings to take seriously?
So it's a judgment call, and it really cuts to the heart of what the role of a director of a board is. I mean, my view is it's the role of a board member to bring his or her views to the table when you're discussing risk. Not all risks require great consideration, and then this differs for every board. So personally, in the case of Bill Gates's talk, which I've watched, I found fascinating, I would be considering the evidence and taking a view, my view, as a director on a board, of the likelihood and the potential consequences for that company. But as I said earlier, most companies, I mean, this was not widely predicted, so the lack of preparedness is not surprising. And as I said earlier, for certain industries, any kind of mitigation, frankly, and the effectiveness of that mitigation has been taken outside of their control, given the nature of what they do. However, I think the key point here is we do have this experience now, so there's no excuse next time it happens.
Yeah. I think that's ever thus, isn't it? It comes back to those judgments, those questions of leadership that managers have, and now with the benefit of the particular circumstances of the past 3 months. We can hope that we will only be better at perhaps challenging some of the things that we consider may have a high impact but a low risk, and just as you said earlier in your presentation, just turning the dial on some of those just a little bit. Well, that completes the questions that we have had. A really special thank you to Ben and to Simon for sharing their insights and thoughts. If you missed any of the details, you will be able to pick them up later from our website, where you can also see copies of our earlier and indeed details of our future webinars. From Aspida Group, we stand willing to assist you with all and any of these matters, as do Ben and his colleagues at Carey Olsen around legal matters. Thank you all very much for joining us. Enjoy the rest of your day.
Thank you.
Thank you.